Have you ever really thought about how a company gets the money it needs to launch, to innovate, to grow? It all boils down to two fundamental ideas: capital and shares. In this explainer, we are going to unpack these concepts using India's Companies Act of 2013 as our guide. By the end, you'll have a super clear picture of how businesses are funded and, who really owns them. So here's our game plan. We're going to start with the big idea of capital, and then we'll break it down piece by piece. After that, we'll dive right into the heart of ownership, what a share actually is, and look at the two main kinds. Then, we'll wrap it all up with the key things you absolutely need to remember. It's really the most basic question in business, isn't it? Where does the money come from? It doesn't matter if it's a tiny startup or a massive corporation. How do they actually pay for their grand plans, their day-to-day operations, their people? Well, the answer starts with this one powerful word: capital. It's the fuel in the engine. Okay, let's jump right into section 1, understanding capital. To really get how a company ticks, we have to start with the financial bedrock it's built on, especially how the law sees it. Right. So in the world of company law, when we say capital, what we almost always mean is share capital. And it's so important to get this. This is not a loan. It's money that shareholders have put into the company in exchange for a slice of the pie, for a piece of ownership. Every single rupee someone contributes means they own a tiny fraction of that company. But here's the interesting part. Capital isn't just one static number. It's actually a series of different classifications that kind of tell the story of a company's fundraising journey. And honestly, the best way to visualize this is to think of it like a funnel. This funnel has 5 distinct stages. As we work our way down from the widest part at the very top, we're getting closer and closer to the actual spendable cash the company has in its bank account. So let's start at the top. Okay, so at the very top of our funnel, we have authorized capital. Just think of this as the legal ceiling. It's the absolute maximum amount of money a company is even allowed to raise by selling shares. This limit is literally written into its founding document, the Memorandum of Association, and you can't go over it without a whole formal legal process. Now, just because a company can raise a certain amount doesn't mean it will. From that maximum authorized pool, the company decides how much it wants to offer to investors right now. That part is called issued capital. So for instance, a company could be authorized to raise 100 crore, but for now, it only decides to issue 20 crore worth of shares. Moving down the funnel, we get to subscribed capital. This is the amount of the issued shares that people, investors, have actually put their hands up and agreed to buy. So in our example, if the company issued 20 crore in shares and investors said, yep, we'll take 18 crore of that, then 18 crore is the subscribed capital. Now here's the neat little detail. A company might not ask for the full price of a share all at once. It could sell a 10 rupee share, but only ask for, say, 5 rupees up front. Called up capital is the total amount the company has officially requested or called up from all the people who subscribed. And that brings us to the very end of our funnel, the most important part: paid up capital. This is the real deal. It's the actual cash that has physically landed in the company's bank account from its shareholders. It's the bottom line, the money the business can actually use to operate and grow. Okay, so we've seen how capital flows down that funnel. Now let's zoom in and look at the actual building blocks of that capital, the individual shares themselves. What exactly is a share? What does it really represent? This quote from a famous old case just nails it. A share isn't just a pile of cash. It's a bundle of rights. It's your stake, your interest in the company, in its assets, its profits, and how it's run. The price is just how we measure that interest. The Companies Act is actually really clear about what a share is legally. First, it's defined as movable property, just like your car or a book. That means you can sell it or give it away. And second, to keep track of all this property, each physical share certificate has to have its own unique serial number. All right, this leads us to a super important point. Not all shares are the same, not by a long shot. Companies can issue different types of shares that come with totally different rights, and understanding this difference is, well, it's key to figuring out a company's whole strategy. So under the Companies Act, share capital is basically built on 2 main pillars. You've got equity and you've got preference. It's probably best to think of them as 2 different classes of ownership, and each one has a very different balance of risk and reward. The name of the game here is preference. Basically, who gets paid first? As you can see in this table, preference shareholders are first in line. They get their fixed dividend before a single rupee goes to equity shareholders. And if the company ever winds up, they get their original investment back first, too. Now, the trade-off for all that safety? They usually don't get to vote. Equity shareholders, on the other hand, take on more risk for a shot at bigger, variable returns and control of the company through their votes. So you could say that equity shares are the real risk-taking capital. These shareholders are the ultimate owners. They're fully invested in the company's future, for better or for worse. The law also gives companies a bit of flexibility here, allowing them to issue equity shares with different or differential rights. And this isn't just a textbook thing. A perfect real-world example is from Tata Motors. They issued Special A equity shares that gave investors a bigger dividend payout. So what was the catch? Well, their voting power was drastically cut. It's a really smart way to attract investors who care more about income than about having a say in running the company. Phew. Okay, we've gone all the way from the big picture view of capital down to the nitty-gritty details of different share types. Now let's just lock in the most important things you need to walk away with. So, if you remember anything, remember this. 1. Capital is a funnel, starting with the maximum authorized amount and narrowing down to the actual paid-up cash the company can use. 2. A share isn't just money, it's a bundle of rights that represents your ownership interest. And 3. The huge difference between equity and preference shares. Equity means ownership, risk, and control. Preference means safety and getting paid first. And I'll leave you with this to chew on. The mix of capital a company chooses to raise can tell you a whole lot about its strategy, its appetite for risk, and the promises it's making to its investors. You see, a company loaded with equity shares might be signaling a high-growth, all-or-nothing plan, while a company with a lot of preference shares might be broadcasting stability. The structure itself tells a story.